Hey, we are back. No Camp, a guy that we've had on for the last two before. This will be his third appearance because he knows his business. This is a guy who is up to his elbows and sometimes his shoulders every day in the commercial note space. And who we talking about? We're talking about the man, the myth. He is the MJ at Exchange.Loans out there. The maybe not the Michael Jordan. He's a little bald now. Although I did like the mohawk you had for a while there, Mike. That was quite Mike. But the clean shave looks pretty sharp as well, Tori. But we got Michael Jimenez on here, guys. If you don't know what Exchange.Loans, check it out. He'll talk about what they do there. But Mike, we're glad to have you at Note Camp again for the third time, bud.
What a wonderful intro. You got my name, my nickname, and you actually got my email address because it's mj at Exchange.Loans. Exchange.Loans, your loan sale marketplace for it's the marketplace for you to buy, sell, and value non-performing loans. Strictly commercial. We do we have done some or we're very active in the single family rental portfolio markets, and that's why I got involved here with Scott. Thank you for having me. Third year. You are correct, third year. And I wanted to get the Scott Carson cut. But yeah, the mohawk had to go since we're getting into the thick of things, it seems, and we've been busy, like you said, on the conferences and everything like that. So mohawks don't go well with bankers.
You need to make sure you save that extra 10 minutes in the morning of just rolling out of bed, not fix the mohawk because you're busy.
Yeah. So and I'll be 41 soon. So maybe I outgrew it. So hopefully I can sell enough notes and then retire and go grow my mohawk again.
There you go, buddy. There we go.
I don't know if I will be. So it was a one-time thing. Okay. So thanks for having me. Here, and what I try to focus on, like Scott said, I focus on all things commercial real estate related to NPLs, non-performing loans, OREO or REO, as some others say, and CRE finance. Just to give you a bit of background on me. Should I start the slideshow or should I just keep talking?
If you want to pull it up and it helps you guys, sure, go ahead, share your slides and we'll go from there. And what I'll do is I'll be here, but I'm gonna quiet my camera there for you, so it's all you.
Yeah, and at any point, if someone has a question, or
I'll moderate.
Just stop me. And if I need to slow down a bit, that's good too.
Will do, buddy.
All right, let's share this one. All right, I'm guessing what we can see this right here.
No Camp
2022.
Yep. There we go. If you want, just put it in presentation mode.
I don't do a lot of these on here. I'm usually
it's really easy. Go all the way down to the bottom, Mike. Go all the way down to the bottom, right hand side, and you see the over one more. So one more to the right. Click on that.
I see.
And that's your that'll work.
Okay, cool. You're like, the guy doesn't know how to do it. I haven't done these in a while.
It's okay. They do actually, there is one way. If you go up to the top now, it should be what's it say? Yep, just try that. Duplicate slideshow.
Is this it right here? Okay, cool. All right, wonderful. So No Camp 2022, let's break it down. Exchange.Loans, the online marketplace for non-performing loans. This is what we're going to go over today. Just basically brief intro and background on me, my company, my 30-second plug here. Then we're going to be talking again about the distressed debt market. This is where you're going to see most of the updates if you're with us last year, where I'm going to show you where we are now, and then I can throw out some Easter eggs there, and then when we're done and we can get into some fundamentals, we can explore that side more. I'm going to teach you guys or show you guys a little bit about sourcing CRE NPLs. Just covering this pretty quickly, and then again, if you guys want to focus on that towards the end when we open it up, I can show you guys live how I do that. Buying CRE NPLs. I don't buy too many. I've bought a few. They've all worked really well, but I think we have about 60,000 investors that we e-blast our stuff out to. We only send you deals. We don't send you any junk, no fluff. So I'll go through with you guys what we deal with on our end on buyers, you know, any kind of advice or tips. And selling your loans, loan sale fundamentals, timeline, process, buyer profiles. And we can chat a bit about seller profiles too, but I'm going to focus on trying to get through this. Get my timer on here. Countdown clock. I'm gonna try to focus on getting through this fairly in a fairly brief manner. I know we got 75 minutes, so I'll try to get through this in about 30 or so, and then we'll have that time to open up to questions. Anything you guys want to know about commercial loans, I'm your guy, and I'll do my best to answer it, or I'll tell you that I don't know. And then we can always look at stuff live. So please be interactive. My goal is to make this the most interactive session for Note Camp 2022. So I'd really appreciate you guys' help with that. Okay, so about me, Michael Jimenez, I'm the founder and CXO of Exchange.Loans, your loan sale marketplace. The name of the company is the URL as well. So it's HTTPS, it's :// letter Exchange.Loans. Basically, like I said, we have a marketplace where we focus on helping investors, lenders, special servicers, and intermediaries buy, sell, and value, which is a new function, value their non-performing loans. Okay, so distressed debt cycle. Where are we right now? It looks exactly, you probably have deja vu from last year if you're on for that one. This one's updated, you'll see new numbers. So essentially there's 4 cycles, just like there's 4 seasons, there's 4 cycles to the economy and obviously to the real estate market. And they all move a little differently at a little different pace between the overall economy, jobs, employments, inflation, which is a big thing right now. And then CRE and, you know, traditional real estate, and then, you know, equities. Everything moves in cycles. This is the overall cycle for the economy. And our focus is going to be on CRE, obviously. Right now, hey, where are we? There's 4 stages, right? Market cycle: recovery, expansion, hypersupply, recession. I think we know why that one's bold. We are technically in a recession. It's been acknowledged and, you know, disavowed by some, but yeah, we're in a recession. Recession is when you have 2 consecutive quarters of negative GDP growth. So when it stops growing so quickly. Also, another thing we can touch base on later, I don't want to get too down the rabbit hole on fundamentals because I know we're all deal junkies at the end of the day. But what we've seen recently, it's called yield curve inversion. Yield curve inversion. And it's not Tom Cruise from Top Gun, right? We were inverted. But yield curve inversion is when basically the standard slope of yields on the varying maturities of bonds or other fixed income assets, but typically bonds, when it basically goes like this or inverts, right? I hope I'm doing that right. It's tough to see. So basically now it's cheaper to or more expensive to borrow shorter term debt than long-term debt. So as time goes by, right, more things can go wrong. So typically that longer term debt, like your 30-year, 10-year mortgages, most commercial mortgages are 10-year mortgages with like 25, 30-year amortization tables. That's supposed to be expensive because it's further down the road and more things could happen. So you want to be compensated that with a higher rate. So when when the yield curve starts inverting, that means something's up. And that's the bond market. That's not equities that go up and go down, you know, daily. The bond market trumps all markets, and when it moves, it's a big market, and the people that are tied to it, they're very serious, and nothing gets by them. So we're seeing all these signals saying that we're in a recession. There's going to be a larger correction. I don't like to say bad or worse or anything like that. And we're seeing those things come to light too that we've experienced, same things that we've experienced back in prior cycles. This time is different though, right? Why is it different? We got here because of hypersupply. What was the hypersupply, right? Because everyone's saying it's not going to be 07, 08 again. It's like, well, of course it's not, because it's 2022. Hypersupply wasn't in residential buildings, right? Because everyone's saying, well, there's not enough housing, right? So it's not going to be like 07, 08. Correct. But what we had even more this time was a hyper supply of debt and a hyper supply of free money, right? Because of COVID. And just so you know, back in 2019, I was calling the next recession because we had yield curve inversion, but then COVID happened, and then the federal government, we saw the moratoriums on foreclosures as well as evictions, and you'll see some of that through these slides, these charts that we'll show you. And then we had them print a massive amount of cash, 40% increase in the overall monetary supply. Took us about, I think, 100+ years to print off that much money, and then we just did it in a couple months. And then we had the triple P and the idle loans, IEDL loans, which basically smoothed out any sort of spike, because everyone was thinking back in 2020 and up to now, where's all the distressed debt, right? Everybody had their cash, they're ready to go. But it didn't happen because of the free money, the deficit spending, right? And the moratoriums. So a lot of stuff there out the shadow inventory. We'll get into that in a bit. And then, now we're seeing it come through the surface where people are paying a lot more for their standard things like groceries, healthcare, gas, and obviously rent, right? So that's what happens. So, just like every good party, you pour out too much booze, you're going to have a hangover. So that's the phase that we're waiting to enter in right now. We just left officially hypersupply phase, and now we're going into recession. Opportunities going forward, same as it ever was. CMBS bank small balance loan, which is SBL, C&I commercial and industrial. Hotel has been number one. Retail, single family rental, and small mom and pop multifamily houses. Those are the folks who, maybe they own a few units and their tenants are still not paying, right? I think they just extended the foreclosure and eviction moratoriums a bit further in LA. So you've got some folks who haven't collected rent for their tenants in over 2 years. It's crazy. Secondly, short sales as well. Those you're already seeing some I don't want to say spikes, but increased velocity of defaults on second liens. Short sales, I think, are going to be huge. I think short sales are going to probably be, I wouldn't say probably, they're going to be huge this time around. So if I were y'all, and if you can't get the loan, because that takes a while, the short sales are going to happen first. Because when things get repriced, everybody was on Zillow, they bought their house, no one can refi out, right? It's going to be tougher. What's the new value, right? So if they start defaulting on their home loans, that's where you can go look at your list pendings and things like that, or your local stuff, and offer them a short sale. I think short sale is going to be pretty big. Okay, and then LSA. What is an LSA? Loan sale advisor. I am a loan sale advisor. I think our firm, me and my co-founder Andre Quadrado, I think we're some of the best loan sale advisors in the country. And if you want to be a loan sale advisor, it's a higher standard of knowledge, execution, and consultation, because your clients are lenders, right? And on my side, my clients are commercial lenders, right? So it's a lot different than just being a broker who's a bit more transactional, or I was a broker as well. I'm trying to get people to sign this lease. I'm trying to show this property, which I'm glad I don't have to show properties anymore. But it's a bit different, and you're really there to consult with your client and give it to them straight, right? So another thing with the LSA is it's and the way we work, and the way, if you're a buyer, you're gonna want to work. If you're gonna want to win these deals and get them closed, you're gonna want to be all cash. Simple as that. So always have your cash ready. NPL fundamentals, I would say that's probably where most folks get a bit hung up, and you're going to see more folks do this, and starting already. They're going to try to switch from brokerage to distressed assets. Number one, know your NPL fundamentals, right? Know your role, right? And know the jargon and the official terms, right? So what does that mean? And I'll try to keep this quick. I think I'm doing good on time here. Yeah. NPL fundamentals, what makes an NPL, right? What's the process, right? What's the process in your jurisdiction, right? Are you in a judicial foreclosure state, right? Are you in a non-judicial foreclosure state? How hard is it to get a receiver? These are the terminology, the terminology too. But I think the biggest thing about NPL fundamentals is knowing what the actual note is worth, where it stands today, regardless of where it is in the default and path to title process. And also for NPL fundamentals, know your role. What do you want to do exactly? Do you want to be a loan sale advisor? Do you want to be a distressed debt consultant? Do you want to work for a receiver? Do you want to sell foreclosures and pre-foreclosures so you can stay more on that brokerage side, right? What we do, loan sale advisor, I sell loans. I'm here to sell loans. I do REO sometimes, which is it's tougher for me. But so figure out your role in the distressed marketplace. This is going to focus more on LSA, but figure out your role and stick to that. If there's one bit of advice I can give you for trying to find deals or grow your business, know your role, stick to it, become an expert. And then no daisy chain. Stay off the daisy chain. I think everybody knows what the daisy chain is, right? It's like when someone's trying to send you an unsolicited tape, right? Data tape is usually what it is. Like you don't even know who this is. It's usually on. Sorry, here, let me silence my phone. It's usually on a daisy chain. I don't think there's anything that's the third rail. That's the third rail of like reputational risk. I don't think there's anything you can do to damage your credibility more than show deals that someone's already seen and that you don't have control over.
Yeah, you don't have control over, or you just sharing and throwing stuff against the wall that aren't real deals. I've had my own list sent back to me that we were trying to sell, somebody trying to sell me back my own deals. You know what I mean? Or I would love to know, Mike, how many people you call that tell you that they're a buyer's rep, that, they got 20, I see he's already chuckling about that, or, you want to talk about that?
Yeah, I get, that's the first thing. And that's why we have, hey, all cash. And I can show you guys a bit more about our process, but if you don't have cash, you're not even going to see the deal. You can see our marketing, you can look at the data tape, you're going to call Andre too. You don't call me. I focus on chasing down these lenders and finding them. Andre runs our trade desk, so he proofs everybody up. We have a very firm proof of funds requirement, and that's why the buyers love our site, because they don't want to compete against guys who aren't for real. And if you don't get many shots with a lender, let me tell you what. Hey, you ever go to a lender and he said no to giving you a loan? Did he change his mind? Right? No is a lender's favorite word typically. That's one thing I learned, and I was a lender. I skipped a bit over my background part, but I don't think it's too important. You can check me out on LinkedIn. So yeah, no daisy chain, know your fundamentals, know your role, know your strategy as well. Focus on all cash buyers. If they don't have cash, they are not going to close. They are not going to close. Same thing with the daisy chain. If you don't control the deal and you can't talk directly to the lender, you ain't getting paid, man. So don't touch it. It's the third rail. And then know whether you're a broker, whether you're LSA, right? Know your role again, and know the difference between the two. Being a broker, you don't want to be a broker. You want to be a loan sale advisor. It's about consulting. Okay. So next one here. I hope that was extensive enough.
Yes, very much so. Good stuff.
Okay, so and we're going to go back over this because this fits back into that greater overall macro cycle of the economy. This is the micro cycle, right? And it changes jurisdiction to jurisdiction. Most foreclosure processes or foreclosure jurisdictions are by county. The states will have their laws, but you got that judge in that county in those cases, right? And that's typically follows for a variety of reasons. But there are, I would rather close in, let me see, we were looking at one in New York, wherever Syracuse was up in upstate New York. I would rather close in that county than ever go to Brooklyn, like Kings County, New York City, New Jersey, Cook County. I don't want to say like the worst. It's very difficult to get for lenders.
It's Crook County. It's not Cook County. It's Crook County, because the freaking don't get me raving on this, because it is so difficult to foreclose there if you don't live in Crook County.
Chicago, first of all, Chicago is one of my favorite cities. I'm there numerous times a year. We'll be there too for the IMN Bank Special Assets West Conference at the October 28th at the Renaissance Hotel. I did my that was like the crown point of my career as a lender. I financed the old IBM Plaza, 330 North Wabash. So I love Chicago. It's a beautiful city, but it is very tough to do business there if you're an out of towner. And it's we got a lot of folks. We sell. You know, we've sold a few notes in Chicago and Cook County. I think Illinois and Cook County is going to be. It may be one of the epicenters for commercial real estate distressed assets. Because and if I'm a lender, I'm bailing, man. I am bailing because you're going to be stuck in that process for 3 to 4 years. So back to this. So what is that process, right? So every loan, right? Every time someone closes, right, and some mortgage broker and some realtor gets paid on another transaction, right? You now have a performing loan, right? It's post origination. I don't want to focus on anything pre-origination. It's originated. The lender gave you that money. You exchanged that loan. You said, "Hey, I'm the mortgagor. I'm going to exchange this loan for liquidity with this financial institution. I give you the loan. Bank or the lender gives me the cash to go close and buy that asset, and then I get that lump sum of cash. I'm sending him a little monthly payment, and every month he's marking it on the books, right? So typically you usually have a default rate of 0 to 2% for most financial institutions. Once you get over 2% default rates, something's up, right? You make 100 loans, one goes bad. It happens, right? For faults, for reasons that may not be the lender or the borrower necessarily, just things go bad, right? Once you get over that 1%, you go over 2%, that's when you're in trouble, and we'll take a look at that later. But most mortgages are, especially now with so much liquidity and financing available in the marketplace, most mortgages are performing. I think the overall mortgage default rate for banks is, I just calculated it actually for this presentation, so forgive me. I think it's around 0.5% default rate for what I designate as CRE. Subperforming, so that's the next stage, right? And it's a variety of things, right? But typically you're 30 to 89 days past due, right? PD on your payment. So you are in a subperforming loan category due to potential or current past due / you're on the road to monetary default, right? So as long as you're under 90 days, and you got to be more than 30 days past due, you are considered subperforming. There's other things too, which is, that's monetary subperforming. You can also be technically non-performing and commercial real estate. Unlike resi and commercial, when they make this loan, this lender's going to say, "Hey, you're running a business here, you're collecting rents. If your income levels, your NOI or your rent or your occupancy drops below a certain thing, but usually below 1.25x or 1.25 times DCR or DSCR, right? Debt coverage ratio, debt service coverage ratio. If you drop below this line, right? So now it's getting close to you can't pay your loan. You're in technical default. You're in technical default. They're going to put you on the watch list. Good servicers will typically see before it happens and move you to the watch list. And then you better start talking to them if you're a borrower, right? And you can also have other things. Borrower could commit a felony. Credit score could change. There's a bunch of things that could basically designate you as subperforming, but the 30 to 89 days past due or missed payments or late payments, that's the key indicator for those. So I hope that was long enough. Then you have officially non-performing, when it officially gets designated NPL. For most commercial assets, it's 90 plus days past due. What happens at 90 days? Pardon me. 90 days is sort of the magic number. That's now where in every jurisdiction in the U.S., as far as I'm aware, you can now, as lender, you can go file notice of default. So depending on what your process is in that jurisdiction, you always serve your borrower and you record the notice of default, and then you can begin the foreclosure process. Some states are great, 30, 90 days, 30, 60, 90 days non-judicial, and some are tough, right? Cook County. But 90 days is the key there. Once they're 90 days past due, that's as a monetary default. NPN versus NPL, that's just for your designation too. If you say NPNs to most folks, especially in the commercial real estate finance industry thing, the thing, right? I gotta slow down a bit. If you If you say NPN, non-performing notes, that's going to refer more to residential and owner occupied 4 units or less, right? If you say NPL, non-performing loan, it typically refers, it's more synonymous with non-performing commercial real estate. So you're talking 5 units plus non-owner occupied on the residential side. And then on the commercial side, a commercial property, your 4 main food groups, and then a bunch of other crazy stuff too that you wouldn't even believe people finance. So the foreclosure process, we touched just a bit on that, right? Judicial versus non-judicial. Do you have to see a judge, right? Do you have to see a judge? Maybe have a jury or something like that, right? It depends if you're a buyer, and depending on what you do, what your strategy is, what your niche is in the distress field. In mine, and especially when I do invest, so I know a little bit about being a buyer. I don't want to go into court. I don't ever want to step forward to court. The only people who win in court is the courts and the lawyers. I look to work things out, and to make sure, and I look for the triple win, right? Lender's happy, borrower got a sweetheart deal, usually cutting him loose if I get a deed in lieu of foreclosure, and I'm happy when I get the title and I sell it off. If things go perfectly, I can sell off that deed in lieu and the title, and then I'm never actually on title, so I have no lender liability, no ownership liability. So that's what I typically look to do, right? That special forces sneaking into that balance sheet in the middle of the night, grab my non-performer, and then, cut the get the borrower off of the note, and then flip it to somebody who wants the fee, right? And then post foreclosure, that's after foreclosure. Typically, you have to go through a sheriff's auction or some sort of foreclosure process, and that's when the lender is going to record title in their name. I can't think of too many cases or in too many jurisdictions. Typically, when the lender forecloses and records title, that's going to wipe out other liens, other than the tax man, of course. And some of them, I think there's new wide green loans that folks know about that, which I'm always interested in learning more about. So those are the only ones. So any lien that's not in priority to the first mortgage or the first lien or the senior mortgage, right? Typically what we think of. Anyone who's not in superiority in claim to title or in lien theory, what have you, they're going to get wiped out on foreclosure, right? Because it's like, hey, you could have showed up to the foreclosure auction, you could have bid, you didn't. Lender's taking property back. So, and I can pause right there for a brief moment here, sip some water in case anyone has any questions.
This is good stuff. I'm glad you brought up the fact that people can be on the watch list even if they are paying the payments on time, because their numbers change and the DSCR, the debt service coverage ratio, reduces below 125%. We saw a lot of that with people, with businesses shutting down, and especially in the commercial space, tenants leaving. Allison asked, what is an REO? That's a REO. That's a foreclosure, a real estate owned.
Yeah. So okay. Yeah. So real estate owned, when you say REO, it's typically going to be from what's called a non-bank lender. OREO is other real estate owned. That's what the banks call it when they foreclose or take an asset back that they formerly had a lien on to a third party. So what does that mean? Why is that? Does anyone know? I'll give you guys a second. Because it fudged me up for a while, because I started off on the Life Co. and Fannie Freddie and CMBS side, right, on the commercial side. So the reason why is because, well, why would it be other real estate owned? Because banks typically own their bank branches. So when we'll look at their balance sheets. They own those branches. That's on their balance sheet as an asset. And technically it was a liability, if they put debt in it on it, right? I don't know if they could, but that's why it's other real estate owned, right? Because if I'm a bank and I have 1,000 branches, which we're seeing all the branches consolidate now, which is interesting, that's my real estate owned. That could be worth a couple million or even $1 billion. That's an asset, right? I can depreciate that and use cut down my tax burden and everything. So that's why banks are OREO. So if you talk to a banker and you want to look at the deals that he already foreclosed on, you got to say OREO. If you say REO, he's going to know, he's like, this guy probably doesn't talk to banks. He probably doesn't close with many banks. So that's just these little intricacies. Guys like me pick up on this, but that's It's because I'm kind of a data junkie.
Well, but that's what makes you good is knowing the data and going from there. And David asked a question: does that diagram apply equally to commercial versus residential? Yeah, it's going to be pretty much the same time frame there for you, David. Yeah.
So that is a really good question. That is a really good question. I'm glad you guys are asking good questions. Really good questions. So yeah, it's the same process, whether it's residential or commercial. Obviously, sometimes you'll have different judges allocated to certain things, right? But it always blows my mind. It's like, why? So it's the same process for someone getting, for like I always use this this analogy, right? It's the same process for the widow and her 8 orphans living in the shoe to get foreclosed and eventually evicted, as it is for the multi-billion-dollar multinational corporation who just said, I don't feel like paying my lease. I don't feel like paying my mortgage, right? So it's the same process for two. I think that's horrible. I think it's horrible. And I think the overall real estate and finance industry and the government foreclosure laws, they should do a better job separating the two interests, because one's commercial, one's like the lifeblood of our economy and our economic freedom and the American dream, and the other is the evil greedy corporate interests like myself here. So this is a slide again from last year, right? When we were in the hyper supply phase, which I know we're in a recession from the economy, right? But real estate tends to lag pretty significantly. Typically, when you see the equities tank and you see that yield curve inversion, it's usually 6 to 18 months until you see it in the greater economy, meaning real estate and commercial real estate. And that has never, it's always been historically accurate. I believe it's the only primary indicator that's been 100% accurate in predicting recessions. So if anyone wants to say otherwise, you're more than welcome to shoot out some info in the comments. So where are we today? So this looks a lot like last year, except it's a little bit different. And I can try to zoom in on these. Shoot. Everyone's like, great, we got another PowerPoint whiz here. Let me move this over here so we can look, because I know it's very small. So loan originations. Oh, shoot. Scooch on over here. So loan originations. It went. It's this is where we were back in 2008, right? Here's where we are now, and that's bank and thrift. That's another key difference between last cycle and this cycle. Last cycle, you see this CMBS right here. See that CMBS? CMBS was the major culprit last cycle, right? Because CMBS, commercial mortgage-backed security. CMBS, I think CMBS is synonymous, and to all you CMBS securitizers, sorry, but I think CMBS is where you go when you want to take a risky deal. When you want to play a riskier game with commercial real estate finance, you go to CMBS. Okay, and there's a lot of reasons for that, but that was the primary culprit in the last recession, or the Great Recession, right? Which blew up. Doesn't this look interesting? Right? So essentially, and this is huge, this is really big stuff here. The fact that the banks and thrifts, which I haven't even seen a thrift, the banks basically picked up where CMBS left off. So there, I said it, I'll own it. The banks picked up where CMBS left off, and the agencies, Fannie, Freddie, right? Everyone says multifamily is doing great. They're in overdrive too. So we are at record origination yet again, and we are well surpassed, or we have well surpassed what we did prior. So, and there's a lot of arguments you can make about supply, pricing, rates, demand, inflation. Obviously, this looks like it's outpacing inflation. And I am concerned, and I've been focusing my business on serving banks because they have much more regulations, or many more regulations, than other lenders, especially CMBS is handled a lot differently. So this was very concerning, and why? Because you have the new CECL requirements that are going to be in full effect come January 1, 2023. You have the transition from LIBOR, London interbank overnight rate, to now SOFR, which I can't remember what it stands for because I don't originate anymore. But so now those adjustable rates for adjustable rate mortgages, those rates are going to be set here locally in New York. I think it's BNY Mellon is setting those. And then you may look with talks of the recession and all the banks putting reserves on their balance sheet. That's so they can stay in compliance with CECL. And the FDIC just released some statements about what they're looking for going forward for working out and going through distressed loans. So to me, it sounds like the banks are very full on CRE. They're starting to cut back lending now. So you'll see that this one will be dipping in a few months because all this information always lags. And then they're going to be pulling back the credit. So it's the old rug pull, which leads to the recessionary event in the greater market. They're going to be cutting back on originations. Rates have gone up and they're going to be pinned down with more requirements. So the FDIC floated this out there and that will eventually become a regulatory requirement potentially. So it doesn't look good for them. The good news is they have a ton of cash. So that's good. Let's see here. So here are the commercial real estate and multifamily housing DQ delinquency rates, right? This is what, like I just said, there's always an information lag. You'll have yield curves. The CRE market and bonds are very slow to move, very slow to react, which is a good thing because it gives them more stability, but eventually they will. So 2007, we had a really big time market slowdown, right? Ben Bernanke, Mr. Helicopter Money did 7 quarterly or FOMC meeting, 25 basis point increases, jacked up the rates when the liquidity and the cycle was going full bore. He wanted to slow it down. Put his foot on the brake a little bit too long, and then a year later, right between here, right where you see this little, it takes off, right, ready for liftoff. That's when Lehman collapsed, right? That's when Lehman collapsed. That set off the systemic risk that we were all concerned about, right? And then we did a $500 billion bailout, and I think this time they did like $1.5 trillion or something. And then it didn't stop or it didn't hit its peak until 2011. And if you were in real estate, 2011, that was the peak of distress. So all the way through 2011 through 2012, and then down to 2014 when the market started coming back, because then they put more liquidity in the marketplace and credit standards eased up. This was the heyday. But we had that initial slowdown event, kind of like we're having now, right? In 07, market didn't, take a dive or spin out of control. DQs didn't. It didn't spike until almost 2009, so a little bit more than a year later. And then we didn't get through that until 2015. So if you just look at 2008 from Lehman collapse to, I would say the recovery was like 2014. That's when the market came back. There were still deals because they're very slow to move them. But you're talking about a 6-year period where there was a lot of distress out there. So I don't have a crystal ball. I don't really try to call it. I just try to serve my clients as best as I can. But I think we're in for a significant correction. So remember when I said 90 days? So I kind of lied. And sorry if I'm using this view versus slideshow. I just want to be able to zoom into some of these charts, and we can take a look at whatever ones you guys want to look at later. Right, banks and thrift 90 days here. CMBS is a little bit different, right? They call it delinquent once it's 30 days past due. Once it's 30 days past due, like they're marking you delinquent. So that's why theirs is a bit quicker to respond. And if you see here, like Carson said earlier, that we saw that spike, you didn't see it as much in the banks, right? Because they have a lot of other loans outside of CRE. They were hit with a lot of those foreclosures, moratoriums and everything. Everybody was, but they were also the ones giving out that triple P money to the borrowers, right? And the businesses that they had the loans with to pay the loans. So that's why you'll see that the DQ for banks is much smoother through the pandemic versus CMBS. Hey, you're 30 days late. Boom, we're marking you delinquent, right? And then they don't really pull any punches when it comes to dealing with those borrowers, right? And they're not going after anybody's houses either. So that's why I see that spike. So, but here's an important part, right? See, it's been going down ever since. There's tons of stuff in there, like even from the last cycle. Spiked, still isn't all the way down, and we can look at some other stuff too. So, but it's again, the big thing is with CMBS, they'll mark you late after 30 days. GSE, that's Fannie and Freddie, that's 60 plus days. So once you're over 60 days late, then they're marking you DQ or delinquent or past due, what have you. DQ, sorry. Fannie Mae.
Mike, let me ask you a question. Ask you a question here, just to give folks a bit of an idea, price or note wise. We're talking really a lot of the CMBS stuff, and especially the GSE is going to be stuff that's usually greater than 5 million in a lot of cases, right? It's going to be a little, it's not a $100,000 loan. It's more of a multi-million dollar in a lot of cases, right, Mike?
Yes. So that's a really good question. So, and trust me, I thought about a lot about this as well. So when it comes to CRE or commercial mortgages, $1 million is the fork in the road. About 50%, and this was a few years ago, so the numbers may have changed due to inflation, but roughly $1 million and less on commercial real estate mortgages, that's about half the market. So half of the entire commercial real estate market is comprised of loans and assets at around $1 million and less. And then the other half, $1 million more. In my career, I think I sold a loan. You said you bought one for $7, man. That's a good one. That's a good one, man. I don't have one that low.
I actually really got it for free because the seller had one condo I wanted to buy. I said, okay, I'll take that condo at that price, but throw these other 3 in for free. He's like, well, I can't listen to contract for 0. I said, well, I don't care. It's all 4 add up to the one price. So one was $7. So
sweet deal. 7 to 5 grand. I like that ROI. I did one. I think we sold one for like 10 or 15 grand. And it was a random piece of land in Chicago. And then, and then, we actually sold one, which I don't tell a lot of people this, but we actually did a $600 million portfolio deal for Fannie and Freddie on an online auction a few years back. I don't know if I was supposed to say that, but I'm definitely, that was when I was at a former company, which I won't name. If they want to come sue me, that's fine too. But yeah, we did a $600 million loan sale for a mixed pool for I'll just say the agencies. Fannie and Freddie, why does that look so different? Right? It's how one's spiking and the other isn't. Fannie is typically, it's a lot of smaller deals, like those $1 million and around there, and it's all multifamily, so 4 plus units. Fannie, I would say they have it's a good way of saying this. I would say they have not only are they doing smaller deals with less institutional clientele, they also do lower income and lower credit demographics. So you'll have your LIHTC, like your low income housing tax credit, and things like that. So I look at it like Freddie's a bit more blue collar. So when that pandemic hit, those people were having a tough time paying their rent, and Fannie marked it as such once they were 60 plus days past due. Freddie, hey, that's the work from home crowd, man. Like you're in a nice Freddie Mac, typically class B and higher. You're usually, Freddie has an SBL program that they started a few years back, but typically before that they were 7 million and up for a very long time. So totally different management, ownership, and sometimes tenant profile, but it could go either way. And I believe Freddie Mac wasn't as quick to market DQ because they were working with a lot of these borrowers. Maybe they did a better job, I'm not sure, with basically getting them their deferments and their forbearances. I believe Freddie did not do that, and not as a wide scale. So that explains that huge differential, that delta between the two. So there's a lot there, and it'd be pretty tough to measure. You want to figure out how that delta came about and what actually drove it. That's like a PhD project, right? So, okay, next slide here. Okay, so where are we now? So we're seeing some of this stuff build up, some of this stuff come to surface. You see the DQs come up. Where are we this overall, right? And where are we versus historical? This is a great chart here. So this is the latest delinquency rates, and the MBA data. It's Q1. That's all we get. Sorry, they haven't released the Q2 data. MBA is the Mortgage Bankers Association. If I had to pick one source for everything like commercial real estate finance related, it would be MBA. TREP is really good. They focus primarily on CMBS, but they're branching out into bank and things like that. And then you have CREFC as well, Commercial Real Estate Finance Council, who has a lovely event every other year down here in Miami. These are the numbers where we are now versus where we were in since 1996 in defaults, and I assume y'all can see that very well because it's blown up here. So this, not all lenders and not all mortgages are created equal, right? So at its peak, which is back in 07, 08, or through 2011, right? CMBS had a default rate of 9.5%. Let that sink in for a while. 1 out of 10 loans went bad, and not just late, like went 90 days plus past due, and had to either get worked out, get modified, get sold, or get taken back by the lender. 1 out of 10 CMBS deals. That's incredible. It's absolutely incredible. Where are they now? They're at 3.5%. They're at 3.5%. I got something else on the next slide that's going to tell you where it might be going. Life companies. I'm a life company guy. I never made a bad loan. Defaults are life companies. You go to life companies or life insurance companies, you go to them. They typically have some of the most aggressive rates. They will have the best structure because they have a lot more flexibility, and they focus on non-recourse lending. Non-recourse loans, meaning you can't be held personally liable for defaults unless there's, you break what's called a bad boy carve out or your guarantee clauses. So life companies, they peaked, and I was there. They peaked at 2.5%. That's not that bad. That is not that bad, right? So, and right now they're basically at 0%. So, and here's the deal: life cos also like conservative loans, so they're not going high up that leverage level. So most life companies, if they have a default, and that's when I first started selling loans, I was at a life co, pay me off. If there's equity in that deal and that guy has non-recourse, I go sell my loan off. They're almost always going to be able to get their full value back unless something hairy was up. So life companies, they're my favorite. Fannie Mae, again, we just looked at the charts, right? It's a little higher right now than Freddie Mac. So this is the default, not just the late page, right? And that's 60 days plus. Remember, CMBS is 30, so it's always going to be a little bit higher typically. Life codes are typically 90 days as well. But Fannie, right? They did a lot better in the, I guess you could say historically in terms of default, right? 1% versus Freddie Mac. I'm guessing, I don't know exactly why. There's, like I said, that's a PhD assignment. So there's probably something going on here that's skewing this, right? Because as you saw, those defaults weren't as bad on the last slide, but here the historical average is they hit a peak that was a bit higher, but still only 3%. And then banks and thrifts, so 4.5% default rate. That was most likely through the savings and loan debacle, right? So probably at the I want to say the early 90s. I want to say. I could be wrong because I wasn't into finance then. But here's where they are now, right at about 0.5%. Okay, I was on the money with that. So here's where, and more importantly, where is the industry? Where's the commercial real estate finance industry? The lag effect and shadow inventory. There's a whole bunch of stuff. This looks, hey, we're not doing that bad, right? And we're not currently. The indicators are flashing. Indicators are flashing. If you know this market, you've been through more than one cycle. I've been through one. You have sort of an idea what's coming. But not all data is created equally as well. Just like we saw, we have those different 30, 60, 90 days past due till we hit defaults. Some folks were including the loans, right? I'll include this as a DQ or a late pay or past due. I'll include this as a distressed loan, even though they're using the government funds to keep me current, right? So not all data is created equal. It's very tough to get a very clear picture out there. So that's kind of what we're doing today, and I'm hoping that's what you guys learn here as well. So this is a good quote. So I'll read it. Sorry if I'll read it verbatim because there's another one. So this is from Jamie Woodwell. He's one of the head honchos there at the Mortgage Bankers Association. Commercial multifamily mortgage delinquency rates that were elevated by the onset of COVID-19 pandemic continue to come down during the first quarter. No surprise there, right? Given the strength in fundamentals and valuations for most property types, delinquency rates are at the lower end of the historical range for most major capital sources. Okay, so as of Q1, hey, everything's doing good, and it'll come down from the COVID spike, right? Okay, here is just another way to look. It looks like we're watching that one of my favorite movie of all time, Predator, Arnold Schwarzenegger, right? Get to the chopper. Looks like we're seeing that infrared. What is this, right? Sorry, let me pour a little bit more water here. So this is a good chart showing the 30, 60, 90 and DQ for the different product sectors or property types, right? So the thing that probably sticks out immediately is this one right here, lodging, right? Lodging got absolutely hammered due to COVID, right? So, and a lot of them aren't coming back for a variety of reasons. Hotels are going to have, or they have been having a tough time. There's been a massive change. You know, a lot of guys sold out, right? And you had a lot of people selling their properties. I was actually on a hotel panel down in California. The amount of portfolios that were sold and transition changed hands I believe it's a record. So, and the reason is because hoteliers are very sharp. They are very sharp. I would say them and commercial real estate developers are probably the slickest guys out there in terms of your borrower, right? They know when they're out of the money. They are watching those numbers every day, and they got to sell those rooms. They got to book those rooms and put heads in beds every single day. So they know their business very well if they're paying attention. They know when they're going to have problems way before everybody else does. So they know when to sell, when they're out of the equity position, and they knew rates were going up. So everybody in CRE and CRE finance, they knew rates were going to come up. So as soon as things opened, they took out their loans, they refied, or they sold the property. So when you had a lot of guys in hotels, you got a lot of adverse selection. Hey, I own 5 hotels. Well, this one's in, downtown New York, and it used to be a business travel hotel, right? And now no one that got like cut in half. So he's gonna sell that one, I'll keep the one in on South Beach, right? Because I'm able to charge double the room rate, and I'm almost 100% occupied. So you had a lot of folks picking and choosing their winners and losers in the hotel. So you saw a lot of trades there, and you saw a lot of defaults as well. Retail's been having a tough time, but I think they're pulling out of it. I think lodging, and I think office. I think office is going to get absolutely rocked because of the work from home or the remote work revolution, which I think is great. You can save on rent and save the world from climate change at the same time if that's what you care to do. I don't want to state my opinion on that stuff. But yeah, so the lag effect. Remember that last slide? Hey, everything's great. Everybody's getting money for their buildings, and this is great. Record volumes and originations, right? This was on a few pages later, driven by record high originations for a first quarter. The amount of commercial and multifamily mortgage debt outstanding climbed to a new high at the end of March 2022. So it's a bit more recent, even though it's still the Q1. So obviously he's saying this in Q2. The recent run up, and here's the key. The recent run up in interest rates and drop in broader equity values will without a doubt affect commercial and multifamily markets in the coming quarters. But the relatively strong fundamentals for most property classes should serve as a stabilizing force. What does that mean? That means we hit the peak. We hit peak value and peak market cycle. I don't know how else to interpret that, and that's the head of the Mortgage Bankers Association. So, and we had that awesome run up after everything got closed up and all that demand got tamped down. We have shifts in hotel and office, And now this is probably it. That was probably the peak of this market cycle. It's been a great run. We first went down the tubes in 08 when Lehman collapsed. Now we hit another peak in 2022. So that's a pretty strong bull run. And just to give you some indication that, right, remember that the CMBS delinquencies, they went up, they came back down, right? Those are the official delinquencies. Remember I said a watch list report. Those are the ones that the servicers are paying attention to. Because why? Because they know there's a lot of funny money in the system. So those are the ones that they think are at a higher risk or an elevated risk of default. Monetary default, maturity default, technical default, right? They're watching them. They're on the watch list, right? So when you call lenders, ask them if they have a watch list or a troubled assets list or something like that, right? Great thing to throw around there to strike up casual conversation. There's always things in the way on the watch list. This is from Tret, which is the big CMBS data and analytics firm. The percentage of loans on the servicer watch list fell 128 basis points, right? Because that spike continues to come down to 21%, its lowest reported rate in 2022. So remember we said, hey, in the peak or at the bottom of the market, CMBS had a 9.5% default rate, 1 out of 10 roughly. Well, right now you got 1 out of 5 on watch list. So let that sink in for a minute, right? That's significant. So, and now rates are up. Rates are up. Equity peaked. How are they going to get refied out? All of those hotels and all of those offices where there's a flight to quality in office too, right? Where, hey, if the workforce can work from home instead of going to the office 2 days out of the week, or just call it split, right? 1 week on, 1 week off, or whatever, you just cut office demand in half. Just like that. Boom. Just like that. And now rates are higher, values are coming down, and everyone's going to start giving this stuff back. And I believe 50% of the CMBS office loans or office CMBS loans, 50% are going to mature between now and 2025, end of year 2025. So you got half of those loans for all CMBS office maturities, half of it. So that means their loans are due and payable 5, 10, 15-year term, right? They're coming due within the next couple of years. So office, what I've been saying, office is the new retail. What happened to malls is going to be happening to offices in weak submarkets, primarily suburban office, because no one wants to do no one wants to do a very long commute when gas is between $4 and $7 a gallon, right? So if I'm an employer, okay, they're all complaining they need more money for gas. How about I just tell them to work from home, right? Problem solved, man. And it's better for the environment, right? So yeah, let that sink in. This is a very, this is a fundamental shift. I think and you can say, hey, office demand will come back. Yeah, well, the population grows, it gets recapitalized, restructured, repriced. Sure. I think the office square feet per employee, that ratio has shifted dramatically. Especially, I think we're just going to need less office square feet per employee. I would say it's probably going to end up getting cut in half. There's a good, I saw a good stat that said about only 40% of office workers have returned back to the office, and it's from a big data firm that tracks who's punching in with their key fob. So they said 40% of all. So that means demand you lost 60% of your workforce reporting to the office. So that is going to show through on these balance sheets. It's going to start happening towards the end of the year, and it's probably going to pick up over the next few years. So I know we spent a little bit of time on that slide. Check my stopwatch here. Okay, I need to hurry up here. We can go into sourcing CRE NPLs. I covered this in a bit more in depth last year. It's pretty much just those main updated slides. But the main thing you want to look, right? I like the rules of threes, right? You in terms of personnel, you want to check on you want to know the asset manager, right? That's your lead. That's the person you're going to call and email and ask them and stay in touch with. The asset manager or the executive, the decision maker, typically SVP, senior vice president or higher. Okay, and it depends the size and the organizational structure of the institution. Whether you want to talk to the CEO, this is my general rule of thumb. Now I don't think I'll ever write this down anywhere. So if you're tuned in, get your notepad. Typically, if I'm looking at banks, $1 billion in assets under management, so 1 billion AUM and lower, you typically want to go up higher on the organizational or the titles, right? You want to talk to the CEO and the CCO, right? Executives. 1 to 5 billion is where they typically will have a special assets group or someone who's like, oh, Jim handles the special assets, right? Once you get 5 billion and up, then they typically will have special assets group or special assets manager or troubled loan or loan resolution. That's when you don't have to go to the guy that's on the board, right, or voting or something like that. Look for an SVP, and I can show you guys more of that on LinkedIn in a few if we have time. The lender, know what type of lender you're talking to. Are you talking to an agency, Lifeco, CMBS? You saw through that stuff. We spent a lot more time on that this year. They're not all the same, right? When a CMBS guy says, yeah, I've got some things on the watch list report, you're like, oh, there's 1 in 5 loans. That means he hasn't defaulted yet. Or you can ask, are they also firm default? You know that they're defaulting at 30 days plus. Know this stuff, right? When you're talking to a bank, know it's OREO. When you talk to a life co, know it's REO, right? CRE, multifamily, NPLs, and REO. Know what you're looking for. Like I said, I like to buy non-performing loans, first mortgage, non-judicial foreclosure states, or judicial foreclosure states that don't have a bad rep. Cook County, right? And I want to focus on commercial and where I think I can get a deed in lieu. That's what I focus on because I think I can get my money in and get it out with as little risk as possible, and I never have to have my name on title. So I think that's the best trade-off in terms of speed of execution, certainty of execution, ROI, and time and lender liability risk, right? Yeah. So the lead, the account, the opportunity. The lead is the person that you're talking to. The account is the lender, right? Whether it's Bank of America, JPM, or Fannie Freddie. The opportunity is specifically what you're looking. That's how you make your money with the opportunity, right? So when it comes knocking, make sure you got all your ducks in a row. Yeah, I don't want to go through too much of this too much more. And the main thing, and I will repeat it very quickly here. How much time do we have, Scott? I want to make sure I'm.
Yeah, you're doing well. I mean, I think
Okay.
we've got the next ones that you started at 12:30, so you got about 30 minutes till the next speaker comes.
Okay, that's good. Okay, so I'll hurry this up. Yeah, the main thing, NPLs and loans are very illiquid. It's our job to exchange those loans for liquidity, and people like us, the special assets, distressed assets guys, we're the ones who can make that timeline for recovery speed up, right? So, and just know the main thing, know that you're not buying the property with an NPL, you're buying the loan. So you gotta claim the property, but you're not buying the property. And also know sort of figuring out what the lender's really going for here, whether he wants to do a quick and quiet sale, what his motivations are in getting out the loan or working out. Try to think through the lender's shoes when you're talking to him or when you're looking at the specific opportunity. And then it's really about the relationships. I would say the biggest piece of advice I can give you if you're a buyer, have all cash, have your proof of funds, know exactly what you want to buy. And when you talk to a lender and say you're a buyer, you can say, hey, I'm either residential or commercial. Tell him what you're looking for. Do not be specific. Do not be specific. He has no idea what's going to default next. You have no idea what's on his watch list. If he sends you a loan or a deal, give him an offer. Give him an offer. If you don't, he's probably not going to send you another one. Say, hey, Jim, not really my cup of tea. I usually focus more on the things I want to take back REO, but here's your offer. Because they have a job every time they do a loan sale or a short sale, they need to prove a market. So if you help him do his job, he's going to help you do your job.
That's huge. Always submit an offer. Yes, because that's what they're looking for. If they take the time to send you something, you never respond back or spend an offer, you're right. They're like, okay, I'm moving on to somebody else. I need to get something. And this doesn't mean submit a ridiculously low ball offer, but still something that makes sense for you and stuff like that.
Exactly. And I'll tell you what, the highest offer doesn't always win.
Yep.
The highest offer does not always win. It's really about what that lender, that key thing that they want, right? Certainty of execution. a quick closing, and whether they want a confidential closing or if they're fine marketing it, that's what they want. Certainty of execution, I would say, is number one. Pricing is good, and then they also care about who they're selling it to.
Yeah, they don't want to see
care.
bad publicity at all, and they also, too. I'm sorry, it's also dependent on how close they are to the community.
Exactly.
You know what I mean? They don't want to be the bad guy a lot of times.
Yeah, they don't want to sell off everybody's homes to some evil corporate, Wall Street fund. But if they can sell it to the guy, White Knight versus Black Knight investing, right? They don't want to sell it to Gordon Gekko. They'd rather sell it to, Sam Zell, right?
Yeah.
So, and if they ask you, hey, know your strategy, know your pricing, and tell them why you're paying that price or offering that price. And if there's something else that they could do, documentation. Hey, did you get it? Deed in lieu is like my favorite way to add value. We added $1 million in a single transaction because we were able to negotiate a deed in lieu on a $8 million UPB. We ended up recovering 95% of the fee simple value of the real estate. I won't tell you what we sold to discount UPB, but borrower wrote a check for $750K to get us to rip up his full recourse guarantee in exchange for deed in lieu, and the buyer came up on pricing $250. So that one document, it's a simple like 2 or 3 page letter, deed in lieu to foreclosure, made us $1 million. Made the client $1 million. So these things are very, very important. So source, qualify, underwrite. Really take a good look if you're making an offer. If you're serious about it, make your offer. Make a strong offer. Quick closing. Be very detailed in all the items you need, but lay it all up on the table because, like I said, the highest price doesn't always win. And know what your strategy is too, right? Tell them like, hey, I seek or I envision to do a loan workout with this guy, or yeah, I'm taking this guy's property. Yeah, that's me. I'm taking it. He's out. I'm in. And then make sure you close. If I don't, you have to close. You have to. If you don't close with a lender, you are done. You are done. And if you don't close with me, you will never win a deal on my site. I promise you that. I promise.
Got a couple questions, Mike, real fast. I want to go with this stuff here. Why, when you mentioned about doing a deed in lieu, why did you not want to be on title?
I'll wrap these up real quick too.
Well, David asked, why is it so important? Sorry, go ahead.
No, why is it so important? So to me, it's important because I would prefer, number one, if I never take title back, that I never actually own the property, and it actually typically moves much quicker. I also don't have a lender liability. Why would that matter, right? So I don't have to worry about paying if the taxes aren't due or if there's some snafu down at the courthouse, right? So they can come back to me, hey, you didn't pay your taxes. It's like, well, what do you mean? I never owned the property, right? So there's less things you have to worry about. And then when you get into hairier stuff, like when I do commercial, we worked with a really great fund, one of my best clients when we were first starting off back in like 2015, 2016. Phoenix Investment Funds, Carson Ferris, he's the CEO there. What up, Carson? We hung out with him down at Dana Point. He specializes in remediating environmentally contaminated property.
Huge. So
if you're pulling heavy metal contaminants, if you ever read a phase 2 report, it's really fun. You're fixing, we had situations where they built a Walmart anchored power center atop a former landfill in Ohio, right? Do you want to be on that title? No, you do not. You do not. So lender liability is endless. So the best way to avoid lender liability is, or owner liability, after you foreclose, don't get on title if you can avoid it. And it's usually it's a little bit less costly on the legal fees too.
Right. Are you talking about putting like the property into a land trust of some sort in a lot of cases, or just holding it in escrow with the owner's or the borrower's name, or not the borrower's name, but the because you're basically working on behalf of the lender and helping them sell the asset on the stuff too. So you're working as a rep for the most part for the lender in a lot of cases.
Yeah, so that is a really interesting statement, and one of the things that helped me get fast tracked through the lender or through the vendor onboarding process for some of these larger institutions. My top 3 clients are PNC Midland, KeyBank and Citus AMC, as well as about 4 dozen other bank and non-bank lenders. I do not represent the lender in a fiduciary capacity. So when you go sell when you're a broker and you're selling property, you represent that seller in a fiduciary capacity, right? Someone makes an offer, you have to deliver to them, right?
Right.
I don't. I'm not your fiduciary. I'm just here to market and sell this loan, which selling loans, there's no real regulations so long as it isn't a qualifying mortgage.
Yep.
Right. So, hey, I'm just here to sell the loans. I'm never on title or anything like that. Right. So that's what I like to do. These are dark, deep waters, and that's where I like to swim.
I got a question for you here. Not to take
we
you off
can,
the stuff.
yeah, no, this stuff is, we went over all this stuff last year, so I can close this here.
This is good stuff. This is great stuff. People are loving this. I question for you, Mike. How are you seeing any banks, maybe in smaller regional banks or more smaller banks, willing to carry financing on an NPL sale, or willing to move it?
Great question. Okay, number one, if and for the resi guys, it's a bit different, right? Because you're like, hey, I really like this one. He's like, I got 3 more at the same borrower. You're like, well, I could get financing for this. So I can't stand looking at my glasses. I sat on it. Now it's like a little crooked. It happened like right before this. It's showbiz though, it's live TV.
That's right, baby.
Yes, you can do financing. So if you're doing commercial, there are certain situations where I will allow financing, and you can go to what someone's called a note-on-note financing. We have our contacts. I know them. I trust them. I've closed with them. They've bought and sold with us. So if there was an instance where I could drive value for financing, then you can do that. If you're going to make an offer, you're like, hey, this is my best all cash offer in a quick close. You usually want to be 10 days or less close post due diligence.
Yep.
You can go hard the sooner. And we do all of our due diligence up front. So our typical close is 3 days. It's as simple as that. So we're marketing it 4 to 6 weeks, and then it's gone 3 days later. Wired funds directly to bank. Buyer, I get paid by a buyer's premium. I do not represent the seller as a fiduciary. I don't store any of their data on my servers, and they do not write me a check. So it makes it much easier for them to work with me. If you're an intermediary, that's what you want to focus on. Buying with financing. Hey, here's my offer, all cash. If you can give me a little bit of time if you need it, and you allow me to have a contingency or non-contingency, right? If I can drop out because my financing couldn't come through, and if you're going to get financing, whatever documentation you have to show that you got that lined up, whether it's a term sheet, quote, or whatever, and let them know who the lender is. So you always want to do things that drive value and certainty of execution.
Right. Now, I totally agree with that. But are you seeing any banks?
Am I seeing it?
So if a bank's got $1 million plus note on their portfolio that the property owners walked away, ready to walk away, where the existing bank will carry financing 80% of potential that note purchase. That's kind of what I'm getting at.
Okay. So I've done that before as a lender, where it's like, basically it's like, hey, here's where this deal isn't that bad. This borrower can't get it done. He can't get the ship into harbor. So I'm going to switch out the captains. That's what they're doing. It's not going to happen a lot, right? And they're going to be motivated to do that typically when they want par. Yep. Hey, I can get you par. Let me sign the note. Here's my down payment. So yeah, for you guys, that's a good strategy. On the commercial side, when the lender decides he wants to sell the commercial loan, he's like, yeah, I want this gone. Right. I want this gone. And there's a lot of times maybe he wants to keep the borrower and wants to sell it off because he doesn't want to ruin that relationship. Or maybe he's like, hey, I'm taking this borrower and every loan on my books and I'm selling it. Yeah. I'm disposing of the credit. So it's a really great question. You got to be careful with that. I think it's more likely to happen on the resi side than on the commercial side, and it's not going to happen on my side.
Well, we've seen it happen more in commercial, sub 5 million for the most part. It's always $1 million to 5 million. Local banks. I mean, we were able to get a couple banks here in Austin actually carry financing where the borrower walked away and actually partnered with us to carry they actually provide the rehab funds to rehab the property and kind of convert the apartment complex.
That's great.
And then also like Synovus Bank, big bank, they literally on their loan sale agreement, they're like, hey, if you're looking for a joint venture, let us know. So we were able to negotiate them carrying financing on a note purchase, and the borrower was willing to do deed in lieu. And so we just negotiated the terms and stepped in, like you said, swapped out one captain for another. So
yeah. Synovus out of Georgia.
Yep.
They're pretty active. If you guys want, I can show you like what else. I'll wait for another question. Sorry,
AC,
anyway.
Andre mentioned something here. He's mentioned one thing that's important to mention that differentiates residential NPNs and non-QM versus commercial NPNs. If you win the bid, a Bailey letter hard document review and QC, what is that, quick claim, is a non-starter.
So and that's for the guys who are, maybe you're in that $500,000 $1 million category and you've closed on plenty of resi notes, and we have this happen a lot. Resi guys try to come on our platform and they try to run in all their process, their resi closing, QM and also non-QM resi. It doesn't work with the commercial guys. I'm not saying there's situation like Carson just said, he got some financing on some stuff in Austin, which is crazy. You found a non-performer in Austin. That's nuts.
It's a few years back, but it's still not there.
Okay. Before Google came into town, right? Metaverse. But yeah, so like Andre said, Andre's my he's my co-founder. He's our CEO, right? As people like to remind me, he's my boss, right? Thank you, Andre. So non-QM and QM resi, you're going to do those Bailey letters. I can never say it right because I never see them. I never deal with them. That's not going to work on the commercial side. And on our site, all the due diligence is up front. They're not going to verify anything for reps and warrants. Yep. A CMBS lender isn't, a special servicer isn't. So it's as is, where is. Yep. So you have to be very cognizant of that. If you're trying to win commercial assets and you try to close it and offer and negotiate like a residential loan, you are really shooting yourself in the foot.
Yeah. Well, that's the thing, is you're never going to get the hard docs before closing really anywhere these days. It's all after. Exactly. It's all 30 days after they'll show up, 45 days later. I mean, it's nice now because used to be if you're buying like a commercial note, like we were buying a apartment complex from Wells Fargo multifamily back a few years back. Mm-hmm. I had to go to San Antonio and book a time to review the hard collateral file. They wouldn't scan it. I actually had to go down there and book a time to take a look at it and look through the file in person. It was all secure. It was an interesting situation, and bring my own stuff to scan if I wanted to take anything back with me, and still sign an NDA that I couldn't, in a lot of cases.
Yeah, that's wild. Yeah, I know stories. We've got some colleagues and clients that remember the old RTC days where they were just like, there's the files. It's just a heap of papers. Go dig on through. Which the deals were obviously better for investors. A little bit more work, a little bit more elbow grease, and a whole lot more shenanigans. So we do our best to avoid that on our site. I can show you guys some of our site. We have a lot of new software. Let's do that, man. I went way too long on that.
You're good. You're fine. We've got some time. We're good.
Let me do this one here. And let me know if you guys, what you want to focus on. I look at things, and I'm going to put it on my big screen over here. That's why I'm looking away. I'm not turning my my nose up at anyone by any means. This is it right here, screen 3. Yeah, I got 3 screens. Right, you guys can see the LinkedIn. There's my messages with Scott Carson. Hey, that's I know that guy. All right, so here's the website, right? Your loan sale marketplace, Exchange.Loans, right? Buy, sell, and then we have some of our featured assets. This one's available for sale right now. This is an active listing. So we've got what we call, and I was told to stop saying this, but it's an open, secure marketplace. Open listings. Anybody can see it. Anybody can snoop around and figure out some basic details. It's secure in that, we'll give you the, all of the friendly, there's Andre right there, right? Foreclosure overview, property details, right? So we have the ability to run timed call for offer events. So it's not an auction, but you still get that sense of urgency with a countdown timer. Because you say, hey, yeah, give me some offers. They're never going to send them in. You gotta hold their feet to the fire. See due diligence, you're coming here. The tier 1 is where we will keep the marketing information. So typically an offering memorandum. Let's hope I got the right password in here today. This is Citrix share file. That's a very high level digital rights management software that we're fully integrated with. So you see here, you can come in here, you can look at the loan sale offering. We typically do this on everything that we offer XL exclusive. So this is when you have our full concierge loan sale advisory services, right? Where it walks you through everything, right? If you're a broker, this is what you're going to want to do if you're a loan sale advisor. And then you have the data tape, which is the same information, just in Excel. And then you'll have the tier 2. Dre, if you're on, I'll request access real quick. Oh no, I'm an admin, I forgot. So tier 2, this is all the hard due diligence here, right? BK, dismissal, appraisal, historical. So this is the real stuff. This is the stuff that with us, it's in a data vault, secure, full digital rights management. You can control access anywhere in the world, log IPs, watermarks, and dead switch it so you can kill it. So after the event, you kill everybody's documents and you ship the originals. And this is why we speed up our closing process and our offer process, because all the due diligence is here. So you got to have certified proof of funds. All right, how do you get proof of funds? Oh, let me show you the cell, right? What's your loan worth, right? We'll just throw in 100 East Main Street, and let's go to Lakeland, Florida. Lakeland I-4 corridor, baby. We did a deal there. So I told you this one, right? We sold the Monster Mud Track.
You told me about.
Yeah, and drag strip racing. So I'm going to go in here, right? I'm a seller, right? Just general info, specifics, details, valuation. And this will give you a very quick rundown of what the loan is potentially worth. And you'll also see our strategy value calculator. I am pretty close. I'm pretty quick at filling this out. So if you'll bear with me for a minute here, and you guys go, this is free. This is free. All you got to do is sign in. So you guys got a commercial loan. You just want some semblance of what it might be worth. Show up here. Dre did this. He's awesome. We've used this same exact model, the math that's behind this. We typically have over 100 fields. We condensed it down to I think 15 or 20. But we've underwritten over 10,000 deals with that same underwriting model.
This is huge, because the fact is that people are, I mean, as we're reaching out to asset managers, we're getting in tapes or individual assets. Being able to put this in there with 15 cells to give you a bit of an idea is great. And it's not a hard, fast final offer, but it's a rough AVM, I guess you could say, for an offering, right, Mike?
Yes, and it's something. So we haven't had to change it up a lot. We'll usually go in there because someone's always going to break the model, and that's what we love too. So we're like, hey, we're engineers. Let's go figure it out. So I just put it in here. PPB, say 1, 2. We'll say 2. So it's right there on the watermark. I'll say 2,000. So it's nice property there. All right, total payoff, we'll say 225, 1, 2, 3. I'm just making it up. Recourse guarantee, we'll say yes. Most small balance loans are full recourse. Yep. Summary judgment received, right? That's huge. Could probably say, deed in lieu possible, but everybody be like, yeah, it's possible. So we say summary judgment. Additional liens, no. Owner occupied, no. We'll generate report. See how long this takes. Cool. So it spits out a value automatically, right? Loan value, that $2 million loan with those metrics, 1.4 to 1.660 in Florida, judicial foreclosure state. Percent of UPB, 70% to 83%. And then you can download it. Generating PDF. This will be quicker because our current design for our report is a bit graphic intense, and we found that out when it started obliterating people's inboxes. Yeah. I'm like, what do you mean you didn't get the report? I started and see.
It was 25 megabytes. It didn't fit the email,
yeah,
right?
Yeah, exactly. So this was all done instantly. I didn't no hocus pocus here, right? Recommendation loan sale. It will not always recommend a loan sale. I promise you that. Like I said, we want to give people great advice. Cost savings, for a loan sale, because that's what's recommend. You're going to save about $337,000 to $383,000, and right on the money, 22 to 28 months. So what does that mean, right? We go through all this, right? Then we have our strategy value calculator. Here's loan sale and reinvestment. And so that reinvestment rate for this is the coupon rate. So we're assuming you can go sell that loan and then go reinvest that money if you're a lender, reinvest your capital for that same rate. So we'll probably add more functionalities later. Standard foreclosure, contested foreclosure. Standard foreclosure means it's going to go through per the process. It won't be contested. So you're not going to have anyone fight you or no BKs, things like that. Contested foreclosure means exactly that. So this is the current, the present value, the time value of money playing out through your different strategies. Sell the loan, contested or uncontested foreclosure. What am I looking at here? Right, and so if you sell it now, you're better off, right? That's why it's recommending a loan sale.
Is that figuring in with every state there being a little bit different in some
every
cases?
Jurisdiction, every single jurisdiction?
Wow.
Yeah,
that's awesome.
So let's see here. And then if you say, hey, I'd sell it for 83%. So this is lender direct. If you're a lender, you can use our software we use to run our process. You can use it to list your own loans. Boom, $199 a month, no seller fee, no commissions, no fees. 199 bucks a month. We haven't released that out to the greater market yet, and we'll probably be doing some trial stuff here to try to capture some of that end of year. If there's any more stuff here. So you just go through here, asset info, note overview, property details. You put your photos in there, and then you will make a wonderful listing just like this. And then you'll go up here to your dashboard. And I know I don't know if we're running over time.
We got a couple minutes before our next speaker, but we're okay.
Yeah, see, and then you'll have your asset right here. Right? And then you'll see draft assets, right? XL value. This is the one I just did, 100 East Mainland, right? Pretty slick, right?
That is slicker than snot. That's awesome.
Oh yeah. So you'll see your due diligence request, and let's see here. So I showed you the favorites functionality. You can add them, you can add them to favorites. So when you're selling, you'll be able to see everybody that added them to your favorites, who signed the confidentiality agreement, and you can use our standard form or upload your own. You'll see everybody who requested access to the tier 2 due diligence vault, and you'll be able to see their proof of funds, as well as when they proofed up, we confirm proof of funds, so you don't have to worry about holding people's bank statements or anything like that. And then you can also track your offers. I don't sell, Andre does, so he's got all the stuff, which we probably wouldn't want to show you that, but I do have, if you want to take a look at what those dashboards look like. Or is there something else I could help you guys with real quick with the last few minutes? How I source leads, what I look at on a bank's balance sheet. Is there anything?
Let's talk about a couple minutes here, how you source your leads.
LinkedIn, man, LinkedIn. Yep. So this is the one thing, it's so much different than brokerage. Brokerage, everybody's at every opportunity, every piece of property, that's on the public record. You can triangulate the lead, the account, right? If there's a corporation, and the opportunity. That's what I used to do when I was a commercial mortgage broker and commercial investment sales guy, right? I'll just be going through there and just cold calling. Here it's different. You're not going to find out who the actual lead on that specific opportunity is. Yeah. And it's so much more fragmented. You might be able to find, hey, there's a foreclosure in the media. Yeah, I can find the lender. Good luck trying to find the guy who's assigned to that loan. Good luck. He needs a reason to answer your call and respond to your email. So that's what I look to do. So, oh shoot, here's the people I was actually talking to. I want to show that real quick. I want to show something else. So I'll look at my leads list. So I have Sales Navigator. Get Sales Navigator. I use G Suite. High touch outreach is going to serve you much better than low touch mass emailing and mass spamming, all that stuff. Lenders are busy. Their inbox is always overflowing, and they don't have time to waste with people they don't know, or people who don't know what they want. Or, hey, I only want to buy this A, B, and C. To say, hey, I buy resi loans, I buy commercial loans, or I buy both. Get them an offer. When you find them, so I like to look at the account. You try to identify an account or an opportunity. I focus on the accounts, and I usually focus on the larger institutions now. So let's say, like you said, we're just going to do Synovus here, just because we said Synovus, right? So you're going to look up here. I'm going to look at their decision makers. Right, and then see Chief Analytics Officer. Synovus is pretty large. I'm not going to go for the Chief Financial Officer. They're going to have special assets, folks.
Yep.
Let's just search special assets.
Yep.
This has been Sales Navigator has not been so right. Director Special Assets, right? So I'll look him up, right? I can and this is just a random guy. I haven't talked to him, and I'm sorry if he sees this. I'm not trying to blow you up. I usually Sales Navigator just started doing this annoying thing where it only opens up here. So you can message them, you can ask them to follow you, connect, view profile. If you reach out to them, try to demonstrate your value. Give them something of value, right? I can say, hey, I understand you work with non-performing loans. I have an awesome tool that's free. You don't need to give me your email address, right? Or I think you do have to log in. Or say, hey, I just bought a note for par. Let me know when your next sale is, right? Think about how you want to message and demonstrate your value and introduce yourself.
Or since he's only been there since 2020, hey, I used to work with Jonathan Blank beforehand.
Yes.
I see you're the new person in charge, something like that.
Yeah,
is
and
always
then
a good one.
and you can always add them to your list. You can save. So then I got a pretty good leads list, which just keeps piling up. So I got a couple of asset management. Those are guys who probably aren't CXO. They're not executives. I got my C-suite right here. Partnerships VCs, bank M&A, right? That's one of the targets I'm looking for because we've had a lot of success there. They're more likely to want to sell stuff off, but it's going to be it's a pressure cooker, man. It's like, hey, if they're under pressure and they need to get a certain amount of dollars, you don't want to be, are they going to trust you with their M&A, right?
Yeah.
So that was a tough one. So save your leads. Make sure you do your research before you call them. For how do you research an institution? I love this one. You know, a lot of people use Distress Pro with Brett
No,
Colombo. No,
Brett sold it off. He's
I
no longer
I know.
there. That's
He's doing
crazy.
stocks now. He's doing
Yeah, I
stocks
know.
now.
But I like the
Sorry.
bank reg data is good. Bauer Financial is also really good for
Bauer,
everybody. Bauer Financial, yeah, they just pull straight off
BAU,
BAUER,
Special
quarterly.
Agent Jack Bauer.
There you go. Bankregdata.com. That's a good one. Yeah.
Yeah, hopefully you guys to change my password now.
No, we didn't see it. We're good.
So I love BankReg. You know, I use this site to find, you know, I know what I'm looking for. I always go to Loan 2012. This guy who runs the site, Bill Moreland, I believe he's out of Texas. He might be out of Florida. He's awesome. He's awesome. He's the guy that runs this, Bill Moreland, and he puts together amazing newsletters every quarter. So I'm looking for these NPLs, right? And I want CRE. And you see here, there's different categorizations of CRE. So owner occupied, no owner occupied, multifamily, know what you want to go for, right? So you can see here, here's all the non-performing loans, right? There's about 3.6 billion, which isn't a lot, it's 0.59%. You can see the defaults right here, one of family junior liens, those are second loans, that has a pretty high. Overall, we're doing great, but I think we're at the peak of the market. That's why. And then you can sort by non-performing. Here's the top, 100 lenders by the amount of non-performing CRE loans, because I'm at CRE on their balance sheets. You'll notice there it's all the usual suspects for the mega banks, right? And then it also shows you, this is very interesting, the non-performing dollar and percentages per bank, like type of bank, right? So that 1 billion, and you see how many banks are under $1 billion. That number blew my mind. So then there's a difference between the guys that are over $1 billion and the guys under $1 billion. Guys under $1 billion are going to be more likely to talk to you. You're going to be more likely to talk to someone that is a CXO, CFO, whatever, and they're going to be more likely to speak with you. They're probably going to have some tighter constraints, and they're going to be more worried about reputational risk and headline risk when they're selling their deal. So there's a lot, and those are going to be the guys more likely to help potentially finance you. You know, you come to Wells Fargo with like, hey, I need to get financed. Like, dude, like we have 3,000 of these to sell this year. Like, I'm not doing that.
Yeah.
Right? Like hey man, I'm an AVP, I'm an SVP. I don't have the authority to do that. I'm dumping this. Right. Yeah. So just if you want to, so what I typically do is I'll get this, and then I'll get a I'll start putting together my leads list, right? So I'll find these accounts. I'll look for them just like we did for Synovus, and then I'll look for those special assets people. And then, if you got, good ways, see here. And then when I make my call list, I cannot show that.
No, don't call it. We're good on that.
We're not calling. We're not calling. I'm just showing. So this is how I make my leads list. Geez. Right. This is the bank. These are the CRE. I combine owner occupied, non-owner occupied, and then I've got my whole list here, and I've got about 700 contacts I got to go start calling and emailing. And I like to use the LinkedIn URLs too. So I got you on phone, I got you on email, and I got you on LinkedIn. For the phone, biggest tip I can give you guys, and I'll leave with this: when you're cold calling, because I'm big time Glenn Ross guy. When you cold call, the person that answers the phone, if they tell you their name, or even if they don't, find out their first name and say it humanizes them. They have a really tough job, which is shooting you down all day. If you say their name and you ask them how their day is, your chances, you're gonna double your consistency in getting through past the gatekeeper. Promise.
Yeah. That's awesome.
Is that good? We good on time?
That's awesome, Mike. As always, you over deliver. We could go on longer, but we've got stuff to do. But great nuggets there. Thank you so much for sharing. Andre, thank you again for hopping in there and making some comments as well. You guys are just And you guys have come a long way in 3 years, and you keep kicking ass and taking names, man.
Yeah, man. And we're, we're self-funded. We're gonna see if we can start scaling this, and then maybe have to go get some investors. So that's where we're looking to do in the next year or so.
Cool, buddy. Well, hey, man, you guys have a great rest of your afternoon. Thank you for speaking. We'll talk next week.
Scott.
Okay, Mike?
Awesome. Thank you for having me. Anybody hit me up, MJ at Exchange.Loans, or shoot me a message on LinkedIn.
Great, then. Thanks, bud.